being recorded at this point. How would I know that? This session is being recorded, it says. Okay, well, I guess it is being recorded somehow. All right, good. We're in good shape then. We can get started. I'm sorry about the problematic beginning, but now we will talk about the markets and what's happening in the market. The Dow is down 288 points. Oh my God. The NASDAQ is positive. The Russell is only down a bit. Well, actually, it's down 1%. And the NASDAQ is down a bit too. I mean, sorry, the S&P is down a bit too. But nothing particularly shocking or amazing. Oil tested 67.85. Holy cow. I would think that well, you can see here you've got a support line, right? So it's bouncing off of that. It should, and now you see whether it's a strong or a weak bounce, and we'll get into that in a bit. Natural gas out of control, just going up and up and up. Gasoline also bouncing off of support, but an earlier support than oil. Down here, 223. Oh my God, did it cost me a lot of money to fill up the car? It's like crazy money. I got whacked at a place that was charging $3.50 a gallon, so it's like $100 to fill up. So how are things going? Things are okay, I guess. Look at gold. Look at this craziness. It went all the way back up to 1835, then it fell all the way back to 1810, basically 1809, and now it's sort of recovering. I mean, gold is pretty buildable down here. It doesn't take much to send it rocketing higher. The dollar has been crazy today. You're not going to see it on these charts. But over here, oh, excuse me. I accidentally woke up at 4 a.m. and I could not get back to sleep at all, which is why my post was done so early today. So I was already bored by 8:30. So as you can see, we had a huge spike up in the dollar. That's a big move for an intraday move, so you don't expect that's half a point. And it sticks. So once it sticks, you say, well, there must be some policy indication of the Fed being a little bit tighter. That's the only logical thing you're going to see there. And we'll find out what's going on at some point. So certainly some kind of Fed speak or something like that. So as you can see, we got the Dow with a nice crash again, but we're only coming back to where we were yesterday. It's not very exciting, and nobody else is coming back to where we were yesterday, except the Russell. You know, but these are still, you know, huge places. You know, we're still like way tippy-toppy on everything. The Nikkei, though, is steadily pulling back. So we'll see if they break down. They're going to have good support. See where they came up here and consolidated, like 26.5. So they should have good support around here. And if we look at this pattern from 26.5 to 30,000, they're basically, you know, they're holding what would be like a bounce line, a strong bounce line most likely. So it's not like you're going to worry about it until they actually do fall below this 26,000 mark. And then you got problems. Their currency is weak though, very weak, and that's holding up the market too. The fact that they're priced in yen and they have a weak yen is helping them a lot. We have a weak dollar; it's holding us up too. This dollar starts plowing higher, we got problems. So the Fed can only very, very gently ease us into something. Oil. Let's get a bigger picture on oil. So oil basically, here's your consolidation, is 72, and really we'd call it 72.50 would be the consolidation, just to be a compromise here. So 72.50 back to 68 is $4.50. But probably 68's an overshoot. We won't know that until this thing completes. But realistically, if we say calculator, hang on, don't like the screen here. Calculator. So basically, you just want to know what the 5% number is. So you take 7250 times 0.95, so 68.87. So 69 is basically your 5% pullback from 7250, and we'll say the rest of this is just some noise for some BS that went on, but 7250 was a more solid consolidation. Also, we know, and also comes from the fact that we know where the points are on oil, and you're going to have 60, 65, 75. I'm sorry, 70. So 75 is the next major resistance. 72.50 is just the halfway point between 70 and 75, but oil tends to move in $5 chains. And you'll see that if you go to a bigger chart, if you're on the W. So on the weekly chart, well, it's not so obvious here, but here's 65, right? You can see these points, point. So 65, you got 60, of course, obviously, and 70, and you can see how those are major points, and up here is 75. That's what I mean. So 75 is the key point down here. There's and then 70 failed, then you go to 65, and between 70 and 75, 72.50. So we're going to call this a fall from 72.50, right there, basically. All right, but look what happened here. Look at these 70. Here's a fall from 72.50. Here's a fall from 72.50, and here's a fall from 72.50. So we haven't had any real success with a big recovery from 72.50 until we get down to here. And see this? See down here this fall? And we're testing the exact same spot on that drop there. So most likely, if it's going to keep going down, this is where we're going to come down to, is back to the $64 range. And 64 would be an overshoot of 65, and then you should get a bounce back to the 65-ish and see what happens there. But but again, this is all what we expected with oil, because we said it was going to be weak between the holidays, and the next holiday comes up at the end of this month. So we are dead between the two holidays, and there's no reason for oil to be higher. Nothing that happened, none of the OPEC, nothing was supportive of these levels. All you have here is the what is it, Memorial Day? I can never keep these ones straight. Labor Day. I guess it was Labor Day that we just had. So so here's a Labor Day BS. There was no reason for this run up. It was just a lot of crap. So now we come back down because this is not supportable, and it comes back down again. And anytime, look, anytime you have to shell out $100 to fill out your car, it's not supportable. That kills demand. Having to spend $100 on gas kills demand. It makes people start thinking twice about taking trips. It makes people think twice about filling up their tank. It makes people think twice about what kind of car they're driving. Your car payment is what, like $300 a month, $400 a month, right, for a car payment for regular people, and you're talking about if you have to fill up. Let's see what the gas payment is. It's so 15,000 miles divided by, let's say you get 25 miles a gallon. So 600 gallons a year times 3.50 is $2,100 a year. So it's $200 a month in gasoline for the average person. And that matters. People don't have an extra, well, let's say that's double what people were expecting to pay. They thought they'd be paying $100 a month, they're paying $200 a month. That starts to hurt. For the average consumer, $100 a month is a big deal. And they don't have it, and they certainly don't have it to do nothing else. In other words, it's the same thing they had to do anyway when they were spending half as much money. They still have, so say they go to the same work, same office, the same travel, they take the same trip, everything's the same, but it just costs more. That's what inflation is, of course. But everything's the same, but it just costs more. It doesn't help their lives any or make their lives better. So what are the variables that are under the control of the consumer? The variables that are under the control of the consumer are take less, drive less. That's variable number one. And anybody who has kids has heard this. Even my kids who have more money than most kids, they still sit there and worry about how much money they're spending on gas and so on and so forth. So they either drive less or they get a car with better mileage. And again, also topic of conversation. I just spent a week with my kids. Topic of conversation with my kids and their friends. What kind of car? What kind of mileage does it get? You start hearing your kids say, what kind of mileage does the car get? You know where things are headed. They're not stupid. It's at some point people start thinking like, hey, how much is this really costing me? If you can save yourself by getting a better mileage car, $1,000 a year, and you're going to have the car for 5 years, that's $5,000. That's a lot of money. So, and then of course, if it's an electric car, you're going to save $10,000, kind of, depending on how you. Now, it's interesting with electrics because it depends on if you consider electricity free or not. Interestingly, in my building and in many places, actually, there's free charging. So we have charging ports. Where my brother lives, there's a charging ports. My mother's building has charging ports. So there's lots of charging ports. My kid's school has charging ports, and in fact, they consider it a bonus if you have an electric car, you get a good parking spot because that's where they put the charging ports, where the good parking spots are. Obviously, we're currently encouraging this, and once you get too many cars that are electric, it won't be a thing anymore. But at the moment, saving $10,000 in gas and getting essentially free electricity is a big incentive for people to go electric. Taking away that expense from people is a good thing. Also, the data so far is that you need less repairs on these electric cars. There's less maintenance and less repairs. So there's actually more and more benefits are getting layered in, and as more and more companies are putting them out, that's going to be interesting. So overall, but that's why there's a ceiling. It's not there's a short-term thinking, long-term thinking, but once you hit that critical point of $100 to fill up a tank, that's when people start changing their habits. That's when people start saying, this is too much money, I can't afford this. And in California, I'm not sure what gas is now in California, but it's a lot. Yeah, California, you're up to $4.38 in California for gasoline already. So that's crazy. And we have to take that into account and see where people's habits start changing, and the airlines start charging more. People start deciding based on that. Also, the tickets get too expensive, and you know how that is. I mean, I look all the time. Is when my kids want to come down, if it's $500, I'm like, $500? What are you kidding? But usually it's like $300 to fly to Florida, $250, $300. You can usually get a ticket. Sometimes it's $500 or something like that. It doesn't really. Again, it goes back to if they were making these decisions as students, just having fun, that money would matter a lot. I mean, I know I used to only visit my parents who lived in Florida when it was cheap. Whenever there was a cheap weekend, I'd be like, I'll go see mom and dad. What the hell? That's back when airfare used to vary like crazy. So now it's not. It's a little more steady now, but generally it's basically from $300 to $500 to fly down. And you haven't seen a lot of inflation yet in the airline tickets and things, because honestly, as much as they talk about everything coming back, the demand isn't there. In fact, this morning we were talking about the cruise ships. Not there. That's a really old one. So we were just discussing that in the member chat. Why is it so slow? Hang on a second, just making a note. Why is it so slow to bring up today's article I wrote? Question mark. I wonder if it's something I did. Okay. So, is today the day I explained the inflation thing, or is that yesterday? I forget. Yesterday. Cruises, that's what we were talking about. All right, so we were talking about Royal Caribbean. A couple of news items came up. They have 36 ships. They have the biggest ships in the world are Royal Caribbeans. They're whatever they call it. They're giant ships that have the pathways in the middle with the mall. Those are incredible. Those are my favorite ships. They're really cool. But they say 80% of their fleet will be back in service, which is a little less than people expected. The ramp up cost to bring them back online and get everything going in is a definitely problem for them right now this year. They're still going to be losing money. Bottom line, they're not going to suddenly make money. I don't know why everybody's jumping into these stocks, because that was crazy. And because the virus isn't really over, they've got to enact a lot of really strong safety protocols. That's going to cost them money. Of course, it costs them money having extra precautions, extra cleaning staff, extra sanitizers, extra this, extra that, less crowds in places they have to allow for, like less people in the restaurant and so on and so forth. All that's going to impact their profitability. So all these cruise ships have it, but you know, the other side of that, not caring about that, means that you are going to risk having bad publicity, that you're going to risk having a death ship parked outside a port somewhere with 500 cases of COVID out of 9,000 people. Only 9,000 freaking people on one of these ships. It's nothing to have 100 cases. If you have a breakout, and that's why they're also, by the way, you'll notice they're sticking to like the shorter term cruises. They're not doing a lot of long cruises. Why? Long cruises give the people a chance to incubate on the ship, and then the symptoms break out and they can't deny it. If it's a 3-day cruise, a 4-day cruise, even a 7-day cruise, the chances are you won't know people caught COVID until they're off the ship. And so you won't have one of those situations like last year where they had these ships, they wouldn't let them come back to port because people were infected. But this is crazy. It's like, why are you doing this? Why are you risking this? And of course the answer is because they're losing a freaking fortune. Here you go. Let's take a look. And again, Royal Caribbean, if I had to be on a ship, either them or Disney. They're the cleanest, nicest ships, and so on and so forth. But I still would never get on one. That's crazy. Right now, with all the unknowns, it's not worth it. So here's where they are. So last year they lost almost $6 billion. This year they're going to lose $3.4 billion. Probably more because they just had a shitty report. $3.4 billion. They're losing, 200, what is that? I don't know. Can't do math. 24, 36, $300 million a month is being burned up while they're trying to get their stuff together. They only make in a good year $1.8 billion. So it's going to take them, what is this, $8-9 billion. It's going to take them 6 years to make back the money they're losing in 2 years. More than 6 years, because they're not immediately going back to 1.8. So by the end of the decade, if you're buying into this now, you're buying into it now after they've already taken the hit. So RCL, okay, there's different ways to look at this. RCO is $133 stock. It's now 70, so it's almost half of where it was. But the problem is, where it was a huge, healthy company that could afford to take a hit like that. Now they're not. Look at this. Bankruptcy risk is down here. They're close. They're getting towards bankruptcy. Health trend here. They can make it, but not if something else goes wrong. What if we shut down again? What if they say, okay, what if in 3-4 months they say, oh, okay, cruises are definitely a problem. We have to ban those. And it doesn't have to be just America. It could be any one of hundreds of countries can start doing this and say, we're banning cruise ships. And there's also other environmental reasons for this. A cruise ship is a carbon machine. It's basically a CO2 machine. It runs around polluting the earth all over. They use massive amounts of energy, massive amounts of fuel. They create a huge amount of waste. And now they're disease carriers. It's like there's many reasons to shut these things down. So it only takes a few countries to start banning these things and saying, no, we don't want this anymore. Because don't forget, the other thing about the cruise ships, they don't have any friends. The friends they have would be like the Bahamas, because the Bahamas is where they will register because the laws are friendly and the taxes are friendly and so on and so forth. But the other countries, they're evading taxes. Everywhere they go, they're evading taxes. They don't register in the US, they don't register in Europe, they don't register in South America or anything like that. They register where they can avoid taxes. They pay port fees. That's it. That's not a huge money generated for these countries. You know, it's nice income for the countries, especially the smaller third world kind of countries, but it's not their main sources of income. And if they piss off if the countries feel it's not safe and it's causing problems, they're going to just stop the cruise industry. They don't care. They don't have friends in these countries. So it's a very, very, very dangerous investment right now because it is a stupidly unnecessary thing. There's no reason to take these risks. It makes no sense. And so it's very easy for people to get behind it, a thing to ban them. But anyway, so if you don't care about that and you think they're going to be okay going forward, then what do you actually care about? Well, you care about the fact that you're paying $18, $19 billion for the company that's capable of generating $1.8 billion in profit or $1.9 billion in profit. So therefore, you got a 10 PE company going forward. That's why it tends to steady itself at this price. See how this is a bottom? And the reason this is kind of a bottom is because here you are with a PE of 10. So it seems attractive going forward. If everything is better, you don't give a crap about what they lost in the past. You care about what you're making going forward, except how much of this is debt. And that's what we need to find out. Say, how much of this money is liquidity, interest. Oh, see this? Here's their interest conversion. They've got some ugly amounts of debt. And you have to be very careful about that because they have to service that debt going forward. So they won't make 1.8 billion going forward because they've got, I don't think it's all debt, but let's say they have $8 billion worth of debt to pay off. Let's say they have $7 billion worth of debt to pay off. That would be amortized over 10 years. It means it will knock $700 million a year off of this. So going forward, they're only going to make $1 billion a year, not $1.8 billion a year going forward. So if everything is great, you've got a company making $1 billion at a $19 billion valuation, and it's risky. And that money is risky. You have no surety of it because at any time, a worse variant of the virus can come along and everything gets shut down again. And then you suddenly lose all this money. And if they take another hit like they just took, it's over. They cannot survive another hit like that. And that goes for all the cruise lines. They're all the same. So, you know, the things seem attractive, but you have to really think about what's really going on. Look at this quality score. One is out of like out of 100, I think. Here, wait. Let's say here. If you ever want to figure it out, if what's considered good, go to Apple. Uh-oh. not that Apple, APL, that Apple. Go to Apple and you'll see what a good company looks like. There you go, 91. Okay, so they're 91. These guys are 1. So that is the worst quality score. Yes, it doesn't get worse. I don't know if they even give a 0. So you honestly see the value, and the value is not considered good for the reasons we were just talking about. Okay, it's not considered good. It's not a quality stock. It's got lots of problems. It seems like a bargain, but it's not a bargain because you have to say this isn't the same industry it used to be. We were young and stupid back here, okay? We didn't think about the danger of cruising well, nobody did, right? We didn't think about the danger of cruising in regards to viruses, even though how many times have we had outbreaks on cruise ships of various things? How many times have there been like Legionnaire's disease and stuff like that? It happens all the time. So it's always been known, and they've had washing hand protocols and things like that at the dining room, especially because these things spread very quickly on cruise ships. They've always been pretty sensitive about the spread of disease and so on and so forth. But this is different because this is an infectious airborne disease, highly contagious. And the quarters on a cruise ship are far too close for you to say that they can be safe. They can't be made safe. It's not possible. You're in too close of a space for too long, and all the people in these cabins are breathing the same air. You're not getting all fresh air. I mean, you can open your windows or whatever, but you won't have your air conditioning. But you're basically, when you close the thing, you're breathing air from a central air conditioning system that's recirculating air throughout the ship. They don't have, they should have, but they didn't spend massive amounts of money on filtration systems and so on and so forth. That's why you get these clusters of people getting sick on the ships and all. And the same goes for something like AMC with the movies. All these things are still, if nothing else, you can pretend everything's fine with so many things, but don't pretend it's fine with entertainment stocks or anything where people have to gather together. It's not, we're not out of the woods on this stuff yet. And you can't, much as you want to be, as much as we all wish this was over and we could forget about it, and I'm sorry I have to keep talking about it, but it's, the vibe I get from talking to people is that people are not adequately concerned. And if people are not adequately concerned, it's my job to raise those concerns. So as much as we'd like this to be over, as much as we want to stop hearing about it, as much as we don't want to think about it anymore, and as much as the market is currently ignoring it, it's still there. Countries are shutting back down. Countries they're trying not to so hard, and mostly because it's the summer. And once the summer ends, I'm not sure what's going to happen. Because the skews that we're getting now from these COVID variants is very, very disturbing. Hopkins COVID dashboard. Look at this map of cases last 14 days. And 276. 204, 17. Oh, good for Westmoreland. King and Queen County. Oh, good for you guys. You must be really spread out. But let's look at a more populated. Whoop. Oh, well, okay. So 1,000 in DC, Fairfax 1,000, Alexandria a couple of hundred, Prince George 1,000, Baltimore 500. Okay, let's remember these are in 2 weeks, and let's remember that when China had 80,000 cases, we decided it was a complete crisis. We have 80,000 cases in this little area in a couple of weeks. China had 80,000 cases over the course of the first 6 months of the pandemic. This is so not over. We've completely lost our ability to think about what's happening. Hang on, let me find that actual Hopkins map, because I mean, we really have just lost our perspective on this thing. And I mean, I guess this is an important thing, but here you go. We're about to hit 200 million cases worldwide. 4.2 million dead, so that's about 2% of the people who get it die, 1 out of 50. We're still horrific. Look at this. You can't even see the country. I mean, this is not really much better than it was last year when we were talking about this and how horrible it was. And that's because of this. Look at this. Look what's going on here. This is last year. This was the top of last year. And here we are today, la-di-da, acting like nothing is wrong. Acting like it's all fixed. This was last year. Forget about that one. But here you go. 800,000, blah, 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 100,000, blah, blah, blah. Here we are here, 700,000, 700,000, blah, blah, blah. So basically, we're about 10%, 20% lower than we were at the height of the problem last year. And it's getting worse. We're trending up. And that's with vaccinations. With vaccinations trending up. Why? The Delta variant is much worse than the original disease that we had last year. It spreads much faster, and so pretty much every unvaccinated person is going to end up getting COVID. That's pretty much a fact. We're getting COVID, the vaccinated people. We're getting COVID anyway. We're just getting it and shaking it off. You know, we're carrying it and not showing symptoms. It's showing up everywhere. It's endemic. It's a big problem. But anyway, so where's the weeklies? I guess you got to go into global map. I guess we click on any country. So India is catching up to us as far as deaths. They're catching up to us as far as cases. Deaths actually are still way behind, but they're catching up to us as far as cases. Brazil is catching up to us in deaths. That's really horrible. Nobody else is close, of course, because we are the winners by far. Yes, we are the best at getting incredibly sick. But if we look at the total U.S. stuff, what are you doing? Really? You can't? Ah, okay, here we go. I see what happens. So if you click on the US, this changes. So we're not worse because we're one of the most vaccinated countries. So we're not worse at this point yet, but look at this spike. Look at what we're doing. This spike, and again, you can't go by one thing, but this spike is almost as bad as it ever was. India, we can get them to change. India is not worse because they went back to a lockdown system. Brazil, terrible, right? Oop, well, that took a while to change. So Brazil is terrible, getting to be as bad as it was. Russia, as bad as it ever was. France, better than it was, but still a big alarming spikes up. UK, bad as it ever was. You know, and it makes as much sense to act like this is over now as it did last July. It wasn't over. And so you have to look at these businesses that had very poor results last year and say, why are you going to have better results this year? Why are you out of the woods? We don't know what out of the woods is. This is a Delta variant of the vaccine, of the virus. There's a lot of letters in the Greek alphabet that have just Delta. It can go on for quite a long time. We still have different flu strains every year. And they they tend to cycle around, and so you get a flu shot that's good for the flu this year, but then it's not good next year because it's a different kind of flu, and then you have to get a different flu shot, but then the other one comes back around, but by then your immunity's worn off, blah, blah, blah. This is going to be our lives now, folks. They are not going to eradicate this. I thought they might be able to eradicate this because, I don't know, I mean, we eradicated polio, we eradicated smallpox, not really, of course, it's still breaking out in little places, but we did it because we vaccinated everybody on the planet. We made damn sure everyone got a vaccine. We went to every little village in Africa and wherever, and we made sure every single person got a vaccine. We found people, we found tribes that were still in the trees somewhere, you know, like buried in the woods of some small tiny country, and we found them and gave them vaccines. And, you know, the Red Cross and everybody went out there because we wanted to. That's how you eradicate a disease. You absolutely exterminate it, so there are no instances anywhere on the planet at all. That's how you eradicate disease, and then hopefully it goes back and disappears and isn't transmitted again in the public. But if you leave it anywhere, it can be transmitted and spread. So eradication, total eradication, where every single instance, and that's what China was going for. But the problem with China, and this is what we were talking about this morning, the problem with China and the reason they're failing, or getting back to, oh, where is China? That'd be a good one to look at on the map. But the problem with China right now, and you can't be more locked down than China is. Where is China? You know what's scary about China? We have to go way down here. Not there, not there, not there, not there. Maybe here. Oh, there you go. 105,000 cases. They had 80,000 last summer. They have 105,000 now. They have 20,000 cases in the entire country since last year. Look at that. Look at this. Oh, beautiful. That's doing the best you can possibly do, right? Still, though, look what's happening. I can't get a number to stay up. It's too small to get it. Oh, isn't that crazy? All right. 68. That's what it says. I thought it came 78. Yeah, so they're under 100 per day. But 100 per day is still not what they want. I can't even tell if there are any deaths. It's hard to even say if there's a thing that's going to pop up here. Look at their vaccine doses. 1.5 billion, 1.7 billion vaccine doses. Now, here's the thing. So everybody in China has had one shot at least, probably. That's where it's mandatory. When you do that and you really vaccinate everybody, this is what happens. You have 100 cases in the country. Not the US, which has, here, we won't have any trouble seeing this chart. There you go. Not 194,000 cases. How many? Very confusing. That's thousands, 640,000 cases. Daily cases, 640,000 people. That seems wrong. That seems too many. Daily cases. 800, really? Wow, that can't be right. How can that be right? How can we can't have 1 million people a day getting sick? Can we? No. What do you think is wrong with that number? That's interesting. Anyway, the bottom line is bad. That doesn't make sense because it's, you know, you have to think in terms like, does that make sense? Can we have 1 million people a day getting sick? That means everybody will be sick by the end of the year. I hope not. I don't think so. But the point being, there's obviously a very large difference. Whatever our number is, there's a very large difference Okay, let's find out. There must be a way to see COVID, United States, tests taken. No, we don't care about tests. Cumulative cases, blah, blah, blah. Cases, United States, total, Maryland. No, not Maryland. Show all. Cases, 39 million. Not really going to get into a daily thing. Well, I guess +7, +20, +50. We are in the hundreds of thousands. Look at that. Just a few states, 50,000, 20,000, 30,000. I mean, that's 30,000 from 5 states. That's pretty scary. So yeah, I can easily see we have 100,000, 200,000. I don't think 700,000 doesn't make sense though. I hope not, God. Anyway, so back to the math. So China is the example of what happens when you force everybody to follow protocols and force everybody to get vaccinated and so on and so forth. And when you take sick people and quarantine them and say, I'm sorry, you're sick, you can't mix with non-sick people. We can't endanger the entire country because you don't want to be quarantined. I'm sorry, you have a disease, you get quarantined. Even in the Spanish influenza, they quarantined people. They had wards of people where they would put them. In tuberculosis, when they had tuberculosis outbreaks, they had hospitals for tuberculosis patients. They put them all in the same place. Because you can't just mix everybody up and say, oh, I'm sorry, I have my rights. Your rights don't extend to the point of infecting other people with a disease that you have. And I mean, it's a terrible thing. And obviously, it kills me that with this trillion, you think of the trillions of dollars of budgets, and they did to some extent do this, but I mean, you just take these empty frickin' hotels where nobody was traveling, and you just put people up and make it like at least a reasonably nice thing that you get stuck. Okay, I'm in quarantine, but at least I'm at the Holiday Inn, and they've got a buffet or something. I don't know. I mean, it's something that makes it not so horrible. Not internment camps, which is basically what China is doing. You're essentially shoved off to an internment camp. But the point is, somewhere in between that, we have to do it. We're the opposite. We're like, oh, it's okay. If you're dying of COVID, you can still go to the store. We're not even gonna make you show that you've been vaccinated and you can go to a movie theater. And that's what pissed me off over at Disney is they don't. Well, first of all, kids under 13 can't get vaccinated. It's not approved. So they're all carriers, basically, as far as I'm concerned. I mean, they're all potential carriers. And you're forced to mix with them, of course. So it doesn't matter that I'm vaccinated or my kids are vaccinated, but everybody, all these people are underage kids. And of course, that's what Disney is about. And you shouldn't go to Disney in that case. But it's a little irresponsible. And it carries out to a lot of things, like in the movies. Like, why do the movies let people who aren't vaccinated go? Why don't you have to show a vaccine card to the movies? I would be way more comfortable if I only went to restaurants, and there's some restaurants starting to do this now. They're only letting vaccinated people come to the restaurant, and I'm very in favor of that. Staff has to be vaccinated. Oh, Disney gave 60 days to their staff, though. Everybody has to be vaccinated in 60 days or you lose your job. It's an absolute. No vaccine, no job. They just put that. People were freaking out. The employees were freaking out about that. I'm like, what are your problem? Everybody in this park should be vaccinated. The only way you should be in the park is to be vaccinated. You can't pretend there's nothing wrong. You can't wish your way out of something like this. This is still a horrifying crisis. This is terrible. Oh, wait, where's my house? Oh, damn it. Oh, well. Anyway, so from an investing standpoint, the point is, the long point we finally get to, the point is, you can't pretend this isn't going to happen again. So just stay away from stocks like this. The people who are affected by this, and I understand, yes, if all goes well, this will be a bargain. We'll look back at this and say, oh, I can't believe you could have bought it for $70, blah, blah, blah. But if all doesn't go well, it could be zero. So why would you take the risk? There are so many great stocks you can get into. We were just talking about Pfizer today, which has now gotten too expensive all of a sudden. But Pfizer was one of the first stocks we bought in the pandemic last year, 2-year chart, because I couldn't believe that Pfizer was still $30. You know, probably around here, I was like, in June, I was like, Pfizer, are you joking? They are the most likely people to come up with a vaccine, and they were one of the first ones to come up with the vaccine. I said, because why? It was a very simple premise. It's because they already were working on the SARS vaccine, and COVID is very similar to SARS. So they have a lot of research already into doing a vaccine for something very similar. So they were likely to come up with a vaccine. They're a great company anyway, and they were trading at $30. This is $255 now. So they were trading 50%. What's 1/3? 255 is 8. So basically, they were trading at maybe $17 billion, $18 billion, or something like that, or $16 billion actually. 16 plus 8. Yeah, so about $17 billion. So they were $17 billion here, and they freaking made $10 billion last year. I'm sorry, 170 billion. They're at 170 billion, and they had made 10 billion last year, and that was a bad year. They made 16 billion the year before. The PE was roughly 10. And now, forget it, because of the vaccine and everything else, $23 billion, $20 billion. They're embarrassed that they're going to make this much money because they're making it off, obviously, a horrible tragedy. But this is not like Carnival. This isn't like investing in the Royal Caribbean. This is a freaking giant mega corporation that has so many different ways of making money, and I can invest in that. So why would I invest in AMC? Why would I invest in Carnival Cruise? Why would I invest in Wynn Casinos? They all have risks. If the disease gets worse, Pfizer will do better. If the disease goes away, Pfizer will still be a great company. Why am I going to risk my portfolio? This is not a time for that kind of thinking, guys. There are plenty of stocks that you don't have to worry about what the outcome of a disease is. It's completely unpredictable. We don't know what is going to happen in the next couple of years. There's no way to say if we can effectively fight this thing or what we're going to do. We can effectively fight it because China is fighting it, but are we prepared to do what it takes to fight it? Are we prepared to be the America that we were 100 years ago when we fought the last great viral outbreak? Are we prepared to do what it takes to get rid of a disease? Because it's not nice and it's not pretty. And it requires people to be forced to do things they don't want to do. And we are a nation of spoiled brats who don't do things that they don't want to do, no matter how stupid it is not to do them. And that's the trick in all this investing stuff. So as you can see, I'm very skeptical about a lot of these stocks. That's why I have a lot of trouble picking things right now, because there's so many conditionals that you have to worry about. Clay says both India and Brazil are underreporting their COVID numbers. Well, there's probably no doubt about that. And he says India's pandemic death toll estimates about 4 million, 10 times the official count. Well, that would be horrible and terrible, and it's very possible. I don't know. Goats and soda is the site you're relying on. Is that right? Or is that NPR? Oh, I see. NPR.org. Okay, so I don't know what goats and soda is. But, it's hard to say what's true and what's not true. But either way, I mean, it's obviously very possible in a country that large that you could be underreporting by a massive amount. And nobody's really definitively gotten to the bottom of it yet. I think NPR is pretty good, though, as far as finding out numbers. But be that as it may, this thing is not over. It's not even close to over because it's a virus. You know, last year I remember that they were talking about reopening, blah, blah, blah. And people said, you know what the problem is? If you reopen, you can have mutated strains of the virus because now we're passing it back and forth. And the larger a population that you pass the virus back and forth through, the more likely that mutated strains of the virus will take hold in that population and then be subsequently retransmitted out through the grid. And everybody said, oh, pshaw, that's not going to happen. That's just science. We don't listen to science. We have our gut. That's the old Bush thing, right? It's like, no. We go with our gut. We don't go with our brain. We make decisions based on our gut. And my gut tells me that we don't want to be closed. So you know, and it's a Bush, Trump, Republican, blah, blah, blah thing that they go through. But that attitude is crazy. But Joe Biden's not immune to this. Just because Joe Biden's a Democrat, he's not listening to the science. When push comes to shove, nobody's listening to the science because the science says shut this thing down. Do what China did. But even China reopened, and you could say, well, you know, they reopened, and like I said, they got 100 cases a day in a country of 1.5 billion people. That's not bad, but it's not gone. You know, and you've got to balance that out. But we're not balancing that. We're reopening water parks and theme parks. And I know you shouldn't pick and choose winners, but you kind of have to. And the water park is not the best thing to have open in times like this. The theme parks are not the best things. The movies shouldn't be open. Why are we doing this? Rock concerts. There was just a huge Lollapalooza something rock concert. I think it was Lollapalooza. Anyway, you know, 500,000 people, whatever the hell came to it. Are you kidding me? What is wrong with us? Why are we so self-destructive? So, you know, again, we don't know where we are. We don't know what's going to happen. But clearly, to pretend this is all done and behind us just because we want it to be is insane. But you know, like I said, even Joe Biden gets in office, and you're facing some very real economic pressures to say we can't kill the summer, we can't kill the airline summer, we can't tell people not to travel, we can't kill Disney, we can't kill Six Flags, even though we should. And that's not the way you fight a disease. And we finally hit 70%. We were supposed to hit 70% by the 4th of July. That was Biden's original plan. They didn't account for how much people are anti-vax. There are places, I think New York is paying people $100 now to be vaccinated. So, which is very unfair, I think, to me. I got vaccinated. Where's my $100? You know, just because you have to drag these people kicking and screaming doesn't mean they should get rewarded for it. You know, and again, it goes back to what I said. It's like you should not be allowed to go to a supermarket unless you're vaccinated. You should not be allowed to go to almost any store unless you're vaccinated. You shouldn't be allowed in a shopping mall for sure unless you're vaccinated. Do that and people will start getting vaccinated. Take away their privileges and they'll start getting vaccinated. Don't give them $100. You stop people in the street like China does and say, where's your vaccine ID? No, you're not just walking into this place where other people are without a vaccine ID. That doesn't work. You want to choose not to participate in society? You go right ahead and choose not to participate in society. Stay home and order, and then have Uber and DoorDash and everybody tell you we're not delivering to you, or we'll drop it at your doorstep, but we will not stand at your door and let you touch us if you don't have a vaccine. We got to put a stop to it sometime. And clearly, we decided to just blow off the summer. We're taking a summer vacation from fighting the virus. And we have another month to go. And So the race in America anyway is to vaccinate everybody faster than the COVID can spread. That's what we're trying to do now. But what you effectively are doing though is the 30% of the population that hasn't been vaccinated is having this rampaging outbreak. Most of these things, so in other words, we have the same amount of infections as we had last summer, except only 1/3 of the population is getting it. The unvaccinated 1/3 is getting it. So they're getting 3 times more per, it's a weird thing. It's all spread out among states. It's like in almost every state, it's the same thing. It's like 1/3 not vaccinated. So, but in the unvaccinated population, this is 3 times worse than it was last summer. And so the race is to vaccinate more people until tough luck on the 15% that end up never getting vaccinated. They're going to end up with like 100% infection rate. And that's fine. They want to get naturally infected and build up natural resistance and whatever, and that's their choice. Great. But don't inflict it on us. And actually, it's not true, though. It's not great because these are the people who create these Delta variants and so on and so forth. These people are spreading the virus back and forth and allowing it to incubate in the population. And anytime you do something like this, you're going to have mutations. And some of these mutations may be successful. And God forbid one of these mutations is so successful that it can't be vaccinated against, that it breaks the vaccines that we have. Because what's a mutation do? A mutation is a virus's way to survive and replicate. So when the virus survives and replicates and keeps running into vaccinated people, it is unsuccessful. When a virus is able to break through and infect vaccinated people, it is then successful. So you are basically challenging the virus to find a way around the vaccine by surrounding unvaccinated people with vaccinated people. So for the virus to be very successful again, it has to find a way around that vaccine. And it gets millions and millions of chances to try because we do not control it. And that's stupid. So bottom line, be careful still with these stocks that are entertainment stocks and so on and so forth. And things where people have to gather is still not a good bet. Speaking of Six Flags, look at this. I mean, they're practically back to where they were in 2019. It makes no sense. See, Six Flags has a model very different than other places. Six Flags, basically, their annual pass is so cheap that it's foolish not to get it. In other words, if you're going to go for more than one day, you should get an annual pass at Six Flags. I think it's like a park ticket is, let's say, $60 for one day, but the annual pass is $90. You know, that kind of thing. So it makes no sense not to get an annual pass. They make most of their money selling people really expensive sodas and stuff. That's their thing. So they just want people in the park, but their parks are packed, like very sadly packed. And I don't trust them at all. Somehow they projected they're going to make money this year. I don't know if that's really happening or not, but again, people are packing in. It's a short season for them. They're not like Disney. Disney is a year-round thing. Six Flags, a lot of their parks are seasonal. They're only open in the summertime. So they have a different model entirely. They just want to pack as many people in the summer. This year, that strategy may be partly working. Oh, here you go. Well, that's an estimate. I don't know if they're the quarterlies. Oh yeah, here's the quarterlies. Hang on a second. Let's see what it breaks down to. Accounts, income statement, interim. So, profit, operating profit, net income. Okay, so here you go. Look, the July quarter, the parks open up. They make $70 million. But look at this before that. Usually, why did it go from June to just interesting how they changed their quarter at some point? December, March, June, September. December, March, June, September. I guess it's because they kind of just a calendar thing, I guess. So 2019, they made a little bit less money. Their big money time is the next quarter coming up. So that's when they should make all their money. 180. 74, 180. That one, I don't know what the difference is there. But then they run into this minus 11, minus 80, minus 130, minus 116, minus 85, minus 95. What a catastrophe. But that's 100, 200, 300, 400, 500, $500 million down. Okay, $500 million down. And their best case scenario is making 250. So they have 2 solid years of profits down. And again, it goes back to, you say, okay, well, fine, I don't care. Right now, I'm buying it for $3.5 billion, and they might make $180 billion, so I'm paying 20 times earnings. But that's only if things go well. All right, so it looks like they actually will do well, because their first quarter was better. Their June quarter was better than probably they thought, because it made $70 million, and they only plan on making $89 billion for the year. So 89 million, sorry, for the year. So probably this is going to come out well for them, and they'll do well. So short term, they might get a little pop, but long term, this is unhealthy. And again, they might have to shut down again. Who knows what's going to happen in the next 6 months? And either way, it's 20 times earnings. You're paying 20. You're paying 20 times these earnings for this stock. So it's not something you want to dive back into. There's nothing special about it, and we don't know how bad things are going to be. But quality-wise, they're way better than the freaking cruise line, right? They're not in horrific shape. Now, Disney, of course, is a multifaceted entertainment company that for some reason decided to screw Scarlett Johansson on her film. I don't know why they wanted to do that. I really don't get it. But Disney, again, is way too expensive now. I mean, it makes no sense. Before COVID, they were $130, $140 company, right? Now they're 200. Now they're 180. So let's see, that's 40, 30. Let's say 30% higher. So let's say they went from 240. Yeah. So let's say they're $240 billion. So $240 billion, $12 billion in earnings, 20 times PE, right? Now it's $300 billion with $10 billion in earnings. Now you're paying 30 times PE. Why are you doing that? Why? It doesn't make any sense. I love Disney. When Disney was 90, we were all over it. But this doesn't make any sense at $172. What the hell? Why am I paying double for worse earnings? There's too much of this going on in the market. I mean, they're a great company. They didn't even lose that much money last year. Not well, comparatively, but $3 billion they could shake off. They'd make enough money to do it. They'll be back up into the tens here. But there's a certain percentage of Disney that's park profit, and you need to think about that, because you don't know if they're going to be able to keep these parks open. Parks, 22.5%, so 22.5% of them is parks. You need to know that when you put money into something, okay? Not only that, though, but of course the films are. Oh yeah, I should go back to that. So not only that, but the films are another big part of what they do. And it's hard to say where that is. Disney Studios, there's different components to it, but the rest of them is, let's say, not the media networks, but maybe 40% is it has to do with the films and such. And somewhere in there is the hotels and everything else that goes on in Disney. So you have to be concerned about how how is this going to impact their revenue? It's if people aren't going to the movies. Now they just had this whole brouhaha with Scarlett Johansson because they did that movie. Who is she? Black Widow. They just did this Black Widow movie, and they screwed her. They did screw her. There's no question about it. Her contract is heavily weighted to pay her based on box office. Fine, because she's confident, they're confident. The deals worked out. If this movie does great, because we're paying you, Scarlett Johansson, based on the fact that you're supposed to be this great big box office draw. And if you're not a big box office draw, then we're not going to pay you as much. And she's like, fine, I'm confident that I'm a big box office draw. So I'll take most of my money as compensated by the box office. But the problem is, when that was done, the box office had a 3-month, 6-month lead time before something would appear on pay-per-view. Now, Disney is releasing the pay-per-view the same day the box office opens. Obviously, the people who see it on pay-per-view, which was $60 million worth of pay-per-views, so $60 million, and they made $90 million in the movies. It made $60 million in the box office. In pay-per-view, and it's even worse because, although frankly, $30 is sick, but they're charging $30 on Disney to see these movies if you want to watch at the same time. It's like wrestling at this point, but they're charging $30 to see the movie. So meanwhile, if you imagine that the box office should be a family of 4 people going to see a movie, or at least 2 people, whatever, it should be $20-something or $30 at the box office. But if there's a family of 4, whatever, more people, and of course people that their friends watch, and so on and so forth. So it's very possible her movie should have been $150 million plus maybe $200 million at the box office had they not released it on pay-per-view at the same time. And she doesn't get that money, and that's complete bullshit. And what Disney should have done is said, we'll give you the same percentage of the opening, especially opening weekend. Give me a break. So logically they should have said to her, okay, fine, we'll pay you for that too. That's, we're going to count that as revenue. They refused. They're going to court. So now she said she's not doing any more Black Widow movies. They lost that, and I don't know. They think maybe it is easy to replace. Who knows? But I just think all it's going to do is cause every single agent who deals with them in the future to iron out clauses so that they'll never be able to screw anybody else. They're doing all this bad shit to screw one person because no one's going to let them get away with that again. So why? I don't get it. I don't see the logic in that move, not for a company this large. It's not like they can't afford to give her an extra couple of $1 million just to make this not be a thing. You're pissing off the fans are pissed off, the stars are pissed off, the agents are gonna, hold them to the fire from now on to make sure none of this never happens again. I don't see how this is any benefit to Disney. I think it's a really poor decision. But anyway, so that's be that as it may. But the bottom line is stock's too expensive, can't be, just too much for this time. And there's a lot of this going around. There's a lot of really overpriced stocks where people are just not thinking, and you want to short them. In a normal market, you could short them, but you can't short this market because the government keeps putting money into it. And the Fed keeps putting money into it, and the money is cheap, and everybody's throwing it around, and there still is nowhere else to go. People who have money, these people, the people who are working, their money goes into 401ks and so on and so forth. That has to go somewhere. The people who are making trillions of dollars, the top 1% who are expanding their wealth at an incredible rate, they've got to put their money somewhere. And the entire stock market is only like $100 trillion, the entire stock market. So when you're putting in, when you have inflows of $3-4 trillion in a year, inflows, that's going to expand the market 3, 4, 5% a year just by the basic inflows that are coming in. And the reality is, since those are inflows, they have a higher impact than that, because it's that used car lot model where people are just buying stocks because they have to. They'll buy the inflated prices, and if nobody's particularly selling, prices get jacked up like this. There's been no reason to panic out, so everybody's just still in. But when there is a reason to panic, what's going to happen is you won't find these buyers. And that's how fast something slips. It goes from 140 to 100. You go 30% down, 35% down in a very short amount of time. So I don't know what to tell you as far as that goes. I mean, there's too many examples of it. And what were we talking about? We're talking about, oh yeah, we talked about CCL and all that. And then we talked about Pfizer, and Stuart has Pfizer, and he was saying, you know, he was talking about getting more bullish. I'm like, we bought this thing at 30, it's at 45, it's up 50%. It's not necessarily something you want to stay in. Well, look at Amgen, holy shit. So Amgen came down hard. Amgen's problem is they're getting the government decided they owe like $3.5 billion in taxes. That's a problem for them. Oh yeah, we're talking about the cruise ships. Look at this. That's the Titanic compared to the Symphony of the Seas, which is one of the big Royal Caribbean ones. That's amazing. So that was one time the biggest ship in the world. It actually held that title for a very long time. The Titanic, 882 feet was no joke. But this guy's 1,200 feet, so it's 50% longer. Way obviously wider. It's like twice as wide. Well, actually, it says that right there, twice as wide. 15 decks. That's crazy. Gross tonnage. That's interesting, right? Because the gross tonnage is insanely 4 or 5 times bigger. Passengers. The crew, you got 9,000 people here. You have 3,000 people here, so 3 times more crew and passengers on this thing. That is nuts. But you know, as big as it is, that's 3 football fields. It's not 1 football field wide. So basically, in this space is 9. In this space is the living quarters here. So in this space is 9,000 people. The rest, this is all like, you know, hanging out areas and things to do. And down here is crew quarters actually, mostly. But in this space here, so here's 6,000 passengers and here's 3,000 crew people. And that's just crazy. And they're all jammed in this indoor, and this is all indoors all day, all night long. They're all indoors, sleeping inside this little area right here. And the middle of that is hollow, so they're kind of pressed on the sides. But you know, we got clubs, restaurants, bars, all these things are open. Broadway's opening back up, supposedly. You know, everybody wants to get back to normal, but I don't think we're ready to get. I don't think it's smart. I just don't think it's a good idea. And unfortunately, you only find out after the fact. You say, "Oh, that was a mistake." Just like opening up last summer was clearly a mistake, and that's why we're in the situation we're in now. Is because we didn't do what we should have done. So we'll see. We will see. Oh, I had a trade idea this morning, didn't I? Was that this morning or was that yesterday? No, it was yesterday. I'm sure it was a top trade. Oh yeah, troughs. These guys make titanium. So, you know, I like boring industrial metals. Well, it doesn't matter what it is. Anybody who supplies something unique to an industry is usually a good thing. That's why I used to like Cleveland Cliffs. Because they make the little they make those ball bearings. The steel, they make steel pellets basically for the industry, and they're melted down and turned into whatever. But the point is, they're the only American guys making it. That was the thing. There was their advantage was being local and not having to ship. And that, you know, we bought them when they were cheap at one time. These guys are back down a bit today, but that's fine. That makes it easy to wiggle into the trade. So for this one, we already have. We sold 10 December 20 puts for $540, $5,400. We're adding this new spread that is $7,500. So 75 minus 54 is $2,100 total. I think I said that somewhere probably. Yeah, there. So our net entry, because we, and now think about how long these played out. I don't have that up. But in the long-term portfolio, I mean, ages ago, we sold the December 20 puts. And they're pretty much done now. It's, you know, we're not at 20, so we're not totally done. But the point is, we're going to roll them and do whatever. We're not worried about it. We don't even mind if we get a sign, but we're probably not going to. We'll probably come back over 20 and they expire worthless. But the point is, we're into net $2,100. Now we're turning it into a longer-term play, and we're buying the $15 calls and selling the 20s, and that's for net $3. So now we're in the $15 calls for net $3. Except we also got on 25, we're taking another $2 off that. So we're really in for net, why did I say 3? Oh, net 3. So we're in the $15 calls for net 3, but if we take $2 off that, we're at net 1. So basically our break even is 16 on this spread, and the most we can make is 20. So we can make 4 times 25 is about $10,000, and say right there, 10,400. So we can make $10,000 on the spread now. If we had left it alone, we could make $5,400 just selling the puts. We're now adding the bull call spread because we have the opportunity. It got cheaper, but still in the channel, and we're jumping on the opportunity to go up. So right now, as a new trade, what I said is if you wanted to do this as a new trade, I like the same thing. You buy the 15 calls, you sell the 20s for 3, but don't forget you have a time advantage because you're in the 15s in February and you sold in December. So if it plays out, if it works well, you can roll these or they might expire worthless. And I said if it's a new, I'd pair the above with a 15. I'd sell 15 short February 17 puts. So right on the line here, and those would pick up 33.75. So then you'd be in for net 41.25 on the $12,500 spread, and you'd have $8,300 of upside. But that's 200% potential upside in just in 6 months. Well, not, yeah, in just about 6 months. And that's what you can do with options. It's just there's so many great ways to do it. Now, and like I said, if we just left it alone in the long-term portfolio, so in other words, if it had just gone up, if it hadn't pulled back and given us a chance to buy the bull call spread, we would have, if it had just kept going up here, we would have made $5,400, no problem. Say thank you very much. Since it came down, we evaluated, and I say, yeah, sure, I wouldn't mind owning 1,000 shares of this for $20. We'll be able to work with that over time. Because again, they make titanium, or they're a titanium miner, but they make, you have to process it. They make titanium. There aren't many people doing that. They've got a very steady market and they're growing nicely. In fact, let's take a look at them, trucks. Is this one? So if you look at these guys, look at how their business goes. Huge investment to get going, but now that they're going, they should make about $400 million a year going forward. They're going to be expanding. They went from 18 to 26 to 27, even though in 2020 we had problems, right? They started making money in 2020. Now 35 and 38. Why are they making less money? Because they're expanding again. They're expanding their production lines. They are in a growth phase. And they have a bankruptcy risk because they are borrowing money and spending their money and not keeping a lot of cash on hand because they want to be able to supply more and more material. And titanium is a big demand metal. You know, as you can see, the value score is 90. I mean, that's pretty damn good. But they are an under-recognized company, and you're buying the whole company for not even $3 billion. And they're making $300, $400 million a year. Now, what's going to happen with them is that this was an investment cycle. Then they made money. Now they're going back to an investment cycle, but they're still making money now. But they're investing a good portion of what they're making into growth. And nobody's recognizing this. They're getting no appreciation for what they're doing at all. Look at this EPS trend. Okay, there's the income. That's crazy. Revenues up nicely, steady growth. So I like these guys a lot. That's why they're a top trade. It's like I think there's a very, very strong probability that these guys will make money. Unfortunately, they don't have long-dated options. That's a pain in the ass. I hate that. But they don't have long-dated options. But very, very solid. So that was our top trade yesterday. And before that was July 28th. Oh, that's not that long ago. HPQ. Oh, forgot about that. Wow, I love my picks. I really do. So, so on July 28th, which is down here, we have a little bit of pop since then. We picked HP. And coming into earnings, I said, look, rather than stressing over whether Apple or Microsoft can justify 30 times earnings, how about investing in a pedigree tech company that only has a $34 billion market cap, but it's making $4 billion a year, 10 times earnings. I happen to be doing the webinar right now. I'm doing it on my HP computer. I love my HP computer. It's a little curved thing. I'll tell you what I got. Okay. HP Envy. That's not it. I thought it was called an Envy. How weird. What is this thing called? HP Curved Desktop. It is called an Envy. That's my computer. Okay. Yeah, there you go. Well, so annoying. That. I love this thing. So I like this. I take this on the road with me because this thing is big enough. It's like 40 something inches or whatever it is. And I put 3 screens up. I do the high resolution. And so I got a screen here. I mean, I'm sorry, a screen. I have a window here and a window here and a window here. So I have 3. It's like having 3 monitors. It's a big thing. I have the kind of thing that artists put their portfolios in. I have that wraps around the screen. I have something like that, and I carry it. It's not that heavy. It's maybe like 20 pounds or 30 pounds. So I carry it, and you have to be very careful. I bumped it on something once, and the screen separated from the backing, but it popped back in. And I take this with me on trips, and it's great. I mean, if I take a car trip, like when I just went to Orlando, this is what I bring with me, and I'm basically fully functional when I'm on a trip like that. Even when I go on a cruise ship, I take this thing on the cruise ship. I always leave from Fort Lauderdale because I can get a lot of work done with this thing. It's only the one internet connection I got to worry about, and I got all my screens on the same thing. It's great, and it doesn't take up a lot of space on the desktop. So highly, highly recommend this computer on the whole. But anyway, so that's an HP. They've got a lot of good stuff. They're still a perfectly good company. I've got an HP laser printer because I finally got sick and tired of these frickin' ink printers with the cartridges and the color ink printers drive me nuts. I bought a color laser printer last year. We still haven't changed the cartridges. You know, I'm not a heavy printer, but I mean, you know, my daily use ink printers, I was constantly running out of cartridges, and for whatever reason, it would always, like, something would run out and the whole printer wouldn't go until I replaced the cartridge. And it was a pain in the ass. And this printer, it's a color LaserJet. I don't know what the price was, but it was some stupidly low price that I was dubious as to whether it would actually work. Bought it in like Staples, and it's an HP though, and it works just like I remember a LaserJet used to be. It's been years since I bought a LaserJet because for some reason they went out of fashion, and I just kept buying ink printers. But I can't believe I ever did that. I really can't. I forgot how great a LaserJet is. It just pops out paper. You hit the button, it goes, and it comes right out in 2 seconds. And the colors are better, the print is better, everything's better. I don't understand why we ever went away from those. I really don't. And the cartridge lasts forever. But anyway, HP, great company. So, where were we? There they are. Oh, HPQ. And for some reason, they don't get the recognition that they deserve. They are up nicely, but 35.5 billion when they're making 4 billion a year is insane. And look at these scores. Again, you got to take it with a grain of salt what these scores are, but they just give you an idea. Quality 82, value 96. Don't care about the management, stock rank 96. It's like, come on. What are you going to do? It's like, what are you going to buy instead of buying Hewlett-Packard? How does anything appeal to you when, how does some other company appeal to you when you can do this instead? And that's how they make that's how we end up making a top trade, because come on, this is ridiculous. Not owning this is foolish. Here's Hanes brand, HBI. I don't know how they've been doing since then. There's no chart. Hanes brand is underwear. All right, so they're not going anywhere so far, but why did I like Hanes? HBI. $6.5 billion, 600 million in profit. So again, PEs of 10 appeal to me. If it's a real company with a good reason to have PE 10, yes, they took a hit in their fiscal year last year. Okay, so fiscal year last year, they done 75. It was a bad year. People didn't go to the store. They sell their stuff in stores. I'm not going to hold that against them. Right? It's not, you don't hold that against them. They're going to go forward. Now they're going to go back to their normal 500, 500, 500, whatever. Here they had you have to find out why something like that happened. This is the year that they redid a deal that they had on, I think it was with I'm trying to say Kmart, not Kmart, like Target, or it's either Target or Walmart. I think it was Target. For the Champion Sports line, and that changed over, and that caused them a lot of problems. But that's all done now, and now they're back to normal. That's when we first started paying attention to these guys, because I was like, that's, the stock sold off badly here. When was that? Back here, they got so cheap that we started jumping in on them, because I was like, this is silly. And they got that cheap again. We should have jumped on it again, but we didn't. But they got that cheap again. And now they're back to like a normal track. But again, they have some risks compared to the other things we're talking about, because they are a retail-oriented brand. People need to get underwear somehow. But basically, I'm sure during a pandemic, a lot of people just sat around in old underwear or whatever. But this is a great, steady company. That's these are the kind of things you do want in your portfolio. And what was our trade? Oh yeah, I'm sorry. So the stock is at 20. I'm sorry. The stock is at 1840, and our trade idea is to take the 15-20 spread. So in other words, this stock is 350 in the money, and we're paying net. And you can do this right now, 225. So we're paying net 225 for this spread. Forget the puts. This spread here is net $2.25. Yet it's $3.40 in the money. You're buying the stock for a discount. It's the simplest thing in the world, and a huge discount. You're paying $2.25 for a spread that's $3.40 in the money. All it has to do is be flat, and you will make a lot of money. You'll make 50% on your money with no margin, no nothing.
Just simply as much money as you want to put into that spread, you will make 50% if they don't go down. All they have to do is not go down. They don't have to go higher. They're already in the money by $3.40, and you can buy it for $2.25. Simplest thing in the world. That is what's great about options. And what's great about, and what are you doing? All you're doing is you're selling more premium than you're buying. It's $15. It's at $18.40. So the intrinsic value of the option is $3.40. You're paying $1.10 in premium, right? So you're paying $1.10 in premium when you buy these calls. But then you turn around and you sell the $20 calls, which are out of the money. So you're selling $2.25 in premium. You're selling $1.15 more in premium than you're paying. So that's where your discount is coming from. You're selling $1.15 more in premium than you paid. So now you bought your stock not for no premium, but for $1.15 less than the actual value. That's your discount that you're getting for this. And that gives you a tremendous upside. So not only do you have that $1.15 upside at the current price, but if it goes up to 15, you get another $1.60. So your $2.25 can turn into $5. You can make 100% if we hit our goal of $20 over the course of the next 2 years. If Haynes goes up 10%, this spread makes 100%. And that's without the puts. The puts have nothing to do with it. Since we like Haynes and we want to own them for the long term, I don't have any problem at all selling the $17 puts for $3.10, because you're netting into the stock for $13.90 actually. You're netting into the stock for $13.90, which is $5 and something below where we are now. Right? So that's about a 30% discount is your worst case. Again, separating out this play. This play has nothing to do with this play, but we are combining them. But this, it's just the concept of being in this play to make 100% upside is only is added to by adding this play. This play separately works. My worst case here is owning it for a 30% discount, and my upside case here is if it stays flat. If it only doesn't go down 10%, we're going to make $6,200 doing that. But they're both great plays, so that's what we do. We combine them. They're both great plays, and because they're both great plays, we're in for net $2,800 on a $20,000 spread that's already $12,000 in the money. So for $2,800, we're $12,000 in the money, and the upside potential is $17,200, 600%. So if Haynes goes from 1840 to 20 in 18 months, if it gains 10% in 18 months, and this is a stock trading at 10 times earnings. So if it goes to 11 times earnings over the next 18 months, if somebody realizes they're too cheap, then we will make 600% return on our cash investment, on our cash outlay. If you don't want to have any margin, then it'll just make 100% or a little bit more than 100% on this very simple spread. And then you just adjust your portion size to the portfolio and adjust your risk accordingly. But these are the kind of trades you can make in a market like this. You don't have to be chasing after crazy stocks. This is a super conservative way to make an incredible amount of money. All right, so the last one was VTRS. VTRS is still very cheap. All right, and they used to be part of Upjohn. This is also one totally ignored. This was an Upjohn, this was Mylan and Pfizer, and it used to be what they called Upjohn. I think you probably remember that name. They've got all these drugs in there, and people do not respect their portfolio at all. And we added this to the long-term portfolio and the dividend portfolio because it's so good. And that was right after the last portfolio review that we did that. Wow, we do a lot of trades. Whirlpool I was still liking. And here we did some put selling. The same thing. These ones we just sold puts. Holy cow. We really got busy with these things, didn't we? I didn't realize that. So since July, we've got 1, 2, 3, 4, 5, 6, same trade, so we'll call that 6, 7, 8, 9, 9. So nine top trades. I don't know why people tell me I don't know. People say, how come you don't make more trades? I'm like, 9 trades in a month or a month and a couple of days. I don't know what people expect. I really don't. And again, it goes back to the top trades. We did a review of the top trades yesterday. I don't know. I maybe I don't do a good job explaining the process. I don't understand it. So here we are, top trades. So in the first 6 months of 2020, we had 27 out of 28 winning trades, and I think we got to 9 out of 10 here, or something like that. Then this is the third quarter. Is that right? Yeah, this is the third quarter of 2020 that we're reviewing here. And we had 9 winners out of 10. So we're 36 successful trades out of 38. And that's again without adjusting or doing anything, just leaving the trade alone and letting it run its course. The 95% success rate. And I just picked 9 more in 1 month, in the month of July. And you can see when we're reviewing them, what we just talked about, there's really good reasons for these things. And I'll tell you, it's interesting because you look back, well, okay, here was Pfizer from September of 2020, obviously kick ass, right? Here's LNG, also kicked ass from these are all from September issue of 2020, whatever. Here's Macy's. Nobody respected Macy's at all, and everybody remembers I was banging the table on that. Everybody knows I think LNG, liquefied natural gas, is the future, and we've been talking about that forever. Pfizer is Pfizer, of course, during the pandemic. How could you not buy that? Viacom. Now, again, we're not optimizing these things. So when I say it made this much money and whatever, that's obviously we got out of Viacom. We're not in it anymore. I think we got back in though. But anyway, we got out of Viacom when it did this because it was stupid. And now it's cheap again. So we're buying it again. It's very simple. It's not a complicated concept. Walgreens, as you know, we're back into buying that again because it got cheap again. But we loved Walgreens when it was stupidly cheap. I mean, look at the spread on Walgreens. We were like at the 35.50 spread. So, you know, and then it went up and flew up, and we cashed out the original one, I'm pretty sure. Intel is our current stock of the year. So, and that was because in Thanksgiving, it was 45 bucks. And the spread we made was for the 45.55 bull call spread. You know, stock of the year isn't the stock that's going to go up to 500% or something like that. It's a stock that's going to hit our numbers. So we're able to make 800%. There's an 800% upside on this spread if Intel just gets to 55, which I thought was ridiculous. We were at 45, and I said, look, if they get to 55, we're going to make 800%. And I very strongly believe the value is 55 or more. And so that's why it's the stock of the year, not because it's going to go to 100. It's because it's going to go to a number where we're going to get an incredible return, and that's our incredible return. So the likelihood of us hitting our incredible return on this stock was the best I felt in the market. The combination of how much we could gain on a spread, how sure I am, and how sure I am that we're unlikely to lose money. That's what makes it a trade of the year, not that it's going to go from 45 to 90. I could care less where it goes as long as we can make money on where it is. AT&T is still ridiculously cheap. Oh, and that's it. Okay, but look at this spread. Okay, let's keep this in mind. Look at the spreads we take. AT&T, Intel, this is back last, September basically, or August. Walgreens, Viacom, Macy's, LNG, Pfizer, all very obvious now, right? At the time, not obvious, because at the time, these were the ones that I was setting up and saying, this is ridiculous. Why are they trading at such low PE? How can people be betting against this? So on and so forth. Just what we just talked about. That's where these come from. And that's what you need to do to set up a portfolio. You don't need to swing for the fences. These 9 trades made $87,000 in a year. That's an average of $10,000 per trade. These are not big, sexy trades. These are just basic trades that all did very well. 9 out of 10 of them did very well. And the one that lost only lost a little bit of money. And by the way, the one that lost was AT&T. That's the one that lost. And I fully believe in AT&T. No, it's not, I'm sorry. It's not AT&T that lost. Which one lost? Oh, it was AT&T, but we had 2 AT&T trades. It was a second AT&T trade, or the first AT&T trade, I'm sorry, the original AT&T trade is down $3,900. But down $3,900, this is a totally great trade. There's nothing wrong with it. We just didn't hit the timing right. That's all. Or at this exact slice of time at the moment, it could be doing better. You know, here it was a winner. Here it's not a winner. Okay, we wait 6 months and it'll be a winner again. But at this exact second that I happen to do this review, it's not a winner. So fine. Doesn't make it a bad trade though. It makes it a great trade for a new trade right now. But anyway, so the main overreaching point is, because I got to wrap this up, the overreaching point of the thing is there's plenty of things to trade. There's always plenty of things to trade. And they don't have to be the garbage that you read about that's trading at 30, 40 times earnings. I understand they could be great companies. There's a lot of great companies. Disney's a great company, but not for 30 times earnings. Apple's a great company, not for 30 times earnings. Okay, it's just like a piece of art in the thing, right? You got, you know, I can get a Liechtenstein for $3,000 and put it up in my house, and I like it a lot. Or I can get a Picasso and put it in the same place for $3 million. I'm fine with the Liechtenstein. I don't need the Picasso. It performs the job, and I save, and I'm taking so much less risk on owning it. Things get overpriced. Things become ridiculous and become faddish, and there's no reason for you to be part of it. You can still find conservative plays to make, and for God's sakes, we found 9 in July. In the last 30 days, we found 9. And those are our top trades. Those are not not counting the stuff that we talked about in chat and whatever. You know, there's obviously been other trades that we've had besides those, but 9 top trades. When I make a top trade, I'm serious about it. And that's the kind of stuff that you got to be looking at. And go back to the previous top trades. Check out these reviews, and you'll see that even when you're looking at these, you say, well, like I said, AT&T right now, you can see there are still obviously stocks we can pick up. So there are still things. You look at Viacom, say, oh my God, Viacom's cheap again. Okay, we made 991% on Viacom, but it's still freaking cheap. It's still crazy low. So, you know, that's something we can get back into. You look at the ones that have taken a dip again and say, this is something maybe that's still playable. Intel, still playable. AT&T, as we said, still playable. If you go back to the previous one, there's 30 other stocks that we picked over in these top trade reviews. You know, and it just breaks my heart when people keep coming to me with these things that are too much. I think today, I think Batman was talking about one. Oh yeah, I'm sorry. He was talking about, I think, one of the cruise lines. I think that's what got me started on this whole thing. I was like, oh, why is that so slow? That's where it would go before. I don't get this. It's interesting. Something in the coding of this particular page is causing a big slowdown. There we go. So what was the stock we were talking about? Look a lot. Yep, there's another one I wouldn't buy. Las Vegas Sands. It seems cheap. It's almost half the price it was, but that doesn't mean it's right. Lumber liquidators. Now there's one I am interested in, except that they weren't. I did look and they weren't cheap. I mean, they're not making enough money to make me happy. It's still too much times earnings. Oh, Stewart was chasing Pfizer, and Yodi. Oh, it's Amgen. I'm sorry. So it's Amgen with Yodi. Yodi, so Yodi's looking at Amgen and he's saying, look, it came down, blah blah blah. And I said my concern is the taxes. It's this tax issue is a possible concern. I could have sworn Batman said something though. SunPower is getting cheap again. We still like them. Nope, it wasn't today. I don't know. I'm losing my mind. Oh yeah, but that's a good one too. SunPower, which we love long term. All right, down 2309. This is important, so we'll look at this one. So P-Man asked, anything changes my stock of the decade thesis? No, obviously no single earnings report is going to change my thesis unless something incredibly bad happened. But SunPower put up solid numbers. They actually beat the earnings this quarter. It's their guidance is down a little bit, but the guidance, when you're a company like this that only has a few $100 million in sales in a quarter, and some of your projects are $20-30 million projects, all it takes is for the project that was supposed to be done on June 30th, it's supposed to be on June 25th, and it gets delayed 2 weeks into July. That ruins your quarter. And so they bump things around and things can't get done, and they have chip shortages and things are getting delayed. So they gave poor guidance, but they are confident based on their conversations with their suppliers that they're going to be fine as of the end of the year, and therefore they're going to hit their numbers for the year. So why would you sell them off just because this quarter didn't work out? It doesn't make any sense. And people know this. If you run a business, you know this. You have good quarters, you have bad quarters. You don't dump the business because you had a bad quarter. You say, okay, are we able? Did we have a bad quarter for reasons that are going to be surmountable? Can we get past it? Can we move forward? Are we going to be profitable in the future? If it is, then you say, fine. So we take a little bit of a loss. But people freak out. It's crazy. This business, I did the math, and I said, look, here's the chart. Their lifetime customer cash flow, $50,000 come out of a typical home will generate $50,000 if they sell all this stuff. Now, more and more as time goes on, they'll be selling all of these different things. Solar, install the solar, $25,000. Give them storage modules, another $10,000. Give them an EV charging station, another $5,000. Smart home services, another $5,000. These are things that customers buy in their experience over time. It works out to spending $50,000 per home. So if we imagine that 1/3 of the homes in America over the next 20 years end up going with solar, and it doesn't make sense that they won't. I mean, all the incentives, all the programs, everything we know about climate change and everything, all points to this is the future of solar homes. So 1/3 could be an understatement, if anything. But so it's 35 million homes times 50,000 per home is $1.75 trillion of revenues coming from homes. That's compared to effectively zero now. It's a brand new market of 175 trillion. And if we say that's going to be over 20 years to get to that point, that over the next 20, just like cable, right? Cable took 20 years, but after about 20 years, everybody had cable. That was 100% penetration basically of cable. We're saying 1/3 penetration in 20 years. Very conservative numbers. And especially when the solar installations are actually saving you money. It's not, cable doesn't save you money, cable costs you money. The solar installations will basically eliminate your electric bills. So it's a completely different thing. And there's incentives. So there's $50,000 per home. If it's subsidized by the government, 20%, now you're spending $30,000 per home. And if you take $30,000 in your home over 20 years that you're going to be in the home, you're talking $1,500 a year to pay for your electricity. It's $100 a month. So you think people aren't, once these programs become embedded, once people understand the savings and the cost of solar panels comes down a bit, you think people aren't going to do this? Of course they are. Instead of paying your electric bill like this, you're going to pay it like that. They're going to get it financed, so you're paying the same basic $100 a month or whatever for your electricity, and that's how you're going to get it from now on solar, but it's going to be clean. So it's a 1.7, and you take that over 20 years, and you figure 87 billion a year. But of course, 87 billion, it's not going to jump from 0 to 87 billion now. So even if you give it 10 years to ramp up to that level, that means down the road, $87 billion is the addressable annual market. And that means that SunPower this decade, because it's our stock of the decade, SunPower by the end of this decade will be participating in an $87 billion market. Even if they only have 10% market share, that's $8.7 billion. They're currently a $1.5 billion company. And they're a large, they're a leader by far in this space. But even if we say they aren't, even if we were saying they don't even, they're only one of the top 10, and they have 10% market share or something like that. Even if they're down there, they're still participating 8.7. Half of that, $4 billion. Half of that, $2 billion. It would be triple the revenue they currently have, even if they completely fail. And again, it's a stock of a decade. Why? Because where they are now is very, very cheap and not reflecting any of this kind of growth. They're being priced addressing the current market, whereas the current market is clearly going to be growing over the next decade. So that's my last point. SunPower, banging the table on SunPower once again. All right, well, thanks everybody for coming. I appreciate it, and we will do this again next week with more exciting trades. All right, thanks guys.